Hello, my friends. Brett Patterson coming at you from the financial capital of the West Salt Lake City, Utah, joined by the big fella, the chairman.
How you doing, Brett?
I'm great.
Good.
I am doing great, and it has been a crazy fun market, Brian. That's what we're going to talk about today.
Some people wouldn't agree with you on that one.
Most people wouldn't.
In fact, I think you're the only one I know that would say that.
Well, let's talk about the market because I do know, and I'll start out with this. There's a fear metric that is published on CNN's money website. It's called the Fear and Greed Index. And yesterday it hit 25, which is extreme fear. During COVID, it hit 3, and that's the lowest I've ever seen it. But 25, that's extreme fear. And I know people listening, some of them have that extreme fear, right? They're nervous of what's happening in the market. So let's talk about what we're doing, what they should do, and where we're at, and what does history tell us.
Okay.
But let's start out with the S&P 500. It's certainly in correction mode. It was down as much as 14.75%. The NASDAQ.
Now that was during...
That was the
yesterday,
low.
the lows of yesterday.
That was the open yesterday.
Okay.
And the NASDAQ was down 22%. Now, we'll talk about what happened yesterday and what's happening today, and we'll talk about that in a minute. But down almost 15%, down 22%. And if you look under the hood of the NASDAQ, it's a lot worse than that.
It's a lot worse.
You've had Apple and Amazon not go down too far, but there's stocks that are down 50, 60, 70%. A lot of them.
Right.
So, bear market in the NASDAQ.
Especially if you own some of those smaller to mid-sized companies in the NASDAQ. The valuations got crazy last year. We talked about this last week, but valuations have, I think, been really extreme on a lot of companies, and I don't feel that way in the companies we own, and that's why we're seeing this big correction in valuations in these smaller, mid-sized kind of growth companies. But a lot of them don't have a lot of earnings, so very high multiples, price to sales, price to earnings, whatever you want to look at, they look pretty expensive.
Okay, so I'm adding something to my list. Let's talk about this list based on what you just said. Why is the market down, and why are we in a correction, or in the NASDAQ a bear market? And there's 3 things that I thought of, and you just added a 4th to me, which should be on the list. First thing is war, right? And we're not going to sit here and say that we're experts on Ukrainian and Russian.
We're not.
We're not. I'm not getting into that. And I've seen people on CNBC that think they are, and they're not. No one knows what's going to happen. No one knows what's in the mind of a crazy man. You just don't know. Right, so war is the first thing. Inflation would be the second. High inflation, we've talked about that at length many times on this podcast. Debt. The country is in debt, and that's freaking people out.
That worries a lot of people.
And then the final thing, and I want to come back to debt, but the final thing that you just mentioned, which we've also talked about on this podcast, is the bubble. I mean, some of these valuations were just insane.
Valuations are crazy in a lot of places in the markets.
And those were bubbles. Mm-hmm. And so that's been popped, and that's healthy, right? War is not healthy, but a bubble popping and these companies being brought back to life to where they should be, it is healthy.
Yeah.
And we don't need to... Do you have something to say on it?
Well, are we going to talk about that more in detail, or do we want to talk about that now?
Let's go to debt.
Okay.
Tell me your thoughts on debt, and let's come back to the bubble.
So debt, studies show that high levels of debt, this goes back, they've studied in history, looking at companies or countries that have high levels of debt, generally have slower GDP growth. And but what we've seen over the last couple of years, this huge increase in the U.S. debt, that has been inflationary. And then we've had supply chain issues because of COVID and those sort of things. And I think the combination of those two things, we're seeing high inflation.
That's the result of the debt
That's the result
and
of the
some of the supply chain issues and really the supply issues that we've had.
Yeah, I don't think investors should sit, worry about the U.S. debt or the government's. We're going to default on our debt. I just don't think that's likely. In fact, I don't. It's pretty much a zero probability that the U.S. is going to default on their debt. So people shouldn't lose any sleep worrying about debt. That's just not something. And the reason why is the U.S. government prints our own currency and issues our own debt in our own currency. So they have a printing press. And when they need to make payments, they can issue more debt.
Some would argue that's the problem.
Well, that is the problem, but it's not. The problem is not that it's not. We're not going to default on our debt because of that. The problem is there's other negative consequences by doing that.
Inflation being one of them.
But it's not. It's not default. That's not the problem.
So it's more of creating a high inflationary because that debt, in large part, especially when the Treasury, the Fed, starts buying assets, that creates growth,
right?
Which has got to end at some point, right?
Right.
And that's why we're seeing a correction right now.
And it sounds like I'm being a little bit contradictory because historical studies show that high levels of debt, we have slower GDP growth, but we're not seeing that right now. So, I'm not sure how we explain that. Our current situation, I think some of that has to do with supply disruptions and those sort of things. And the bond market, if you look at the bond market, we see the 30-year at 2. I don't know exactly what it's less than 3%.
Yeah.
The 10 years at 2% today. I think if the bond market, the bond investors believe that our inflation situation that we're in right now would last 5 or 10 years, we would see interest rates significantly higher. We would see, I don't know, maybe 5 or 6 or 7%.
Yeah, the bond market has been pretty stable.
A 30-year Treasury,
which is a good forecast to what could come.
So the bond market doesn't believe that inflation is here long term, which generally bond investors and bond traders are the smartest guys in the room. Generally, I mean they're pretty smart.
Except their product stinks. I'm just kidding.
No, but
I'm kidding. They are smart.
Yeah,
really smart.
We don't hate. Let me just, since you brought it up, we don't hate bonds. We just don't like them right now.
That's a fair statement.
Because
in the future we may.
Listen, when I was in the 90s, when I started in this industry in 1989, and we saw that I think the 10-year was at 6 or 7%. I don't know, but it was in that neighborhood, 6 or 7% 10-year Treasury yield.
That's not bad.
And at that price, that's actually very attractive. And so if we saw interest rates move to 6 or 7%, that's going to be competition for stocks. A lot of investors say, "Oh gosh, I can get 6 or 7% in risk-free government bonds. Why would I put my money at risk in owning stocks?" So I think valuations would come down if we saw significantly higher interest rates.
And we'll adjust at that point and talk about why we would adjust.
Yeah. So it's not that we hate bonds; we just don't like them right now. Period.
Yep.
Generally.
And if a client has bonds in their portfolio and wants to talk about it, call us. More than happy to talk about it.
Hey, one of the best investments I've ever made in my career was bonds. So in 2008 and 2009, high yield bonds were trading at 17-18% yields.
That's pretty good.
And we bought some of those, and over the next 2 or 3 years, we did incredibly well. One of the best investments I've ever made in my career. So I don't hate bonds.
Guess what?
You got to get paid, though.
The only thing I've ever tried to do with bonds is short them. And guess what? I've never made money on it. It's such a hard trade. Anyway, that's debt. And look, the reality is we're pretty fiscally conservative here. We don't like debt. We don't like our country being in debt. So we have to get this problem under control sooner rather than later, for sure.
Yeah.
But from debt being a huge catastrophic event for this country. We just don't see that in the future.
Right, and I mean there are negative consequences, and we'll see how this plays out with the level of debt we have. One of the things we used to talk about after the financial crisis is, well, one of our ways to get out of this debt situation is to deflate our currency or inflate our currency and inflate our way out of debt, and that's kind of what we're doing right now. Inflation, you think about buying a home 30 or 40 years ago, and a home that now costs $300,000 maybe cost $10,000 30 years ago, or something like that. That's inflation.
Yep.
So one of the ways we get out of this situation is inflation. We do want some inflation, but not 7% or 8%.
Last thing on debt. It's relative to the income that's coming in as well, and people forget that. This country is generating in taxes more than it ever has. And so you have to look at debt within that prism as well. A loan for me, a $500,000 loan for me is not a big deal. A $500,000 loan for a dude making 20 grand, that's a big deal.
Right. It's all debt relative to your income.
Yep.
And the bank's if you go in for a loan, the bank's going to talk to you about your income. Well, there is no country in the world that has more ability to take on debt than the United States. There's nobody. We are the strongest house on the block, and we have more ability to service debt than any other country in the world, without a doubt. And so it's always, you have to look at debt relative to GDP, not just in people look at the United States debt and say, "Gosh, it's huge," but it's all relative.
Yep.
It's relative
Exactly.
to the strength of our economy. We have the strongest economy in the world, and people that complain about the U.S., well, where do you want to go that's any better? There's not a place better in the world than the United States, and even though we have our problems,
Yep.
plenty of them.
Got a few weeds in the front yard, but hey, we'll pull those soon.
Yeah.
All right. That's war, inflation, debt, and we've talked about the bubble before and these assets coming back to reality, essentially. But let's go back to war for a second here. And we're not going to be war experts, because we're not. But yesterday in the market, that was Thursday, we opened down 3% on the news that Russia had invaded Ukraine, which they had. The market was down 3%. And I'm talking about the NASDAQ, it's a little over 3%. We finished positive 3% on the day. I've never experienced that intraday range. It hadn't happened since 2000. As a trader, I've never experienced that. That was insane. Why did that happen?
I think it was 6.8% swing in one day in the NASDAQ.
And today we're up another 1.5%, 2%, somewhere in there, depending upon when you look at the
from the high to low.
Yeah.
I think there's a couple of reasons for that. Well, besides, maybe news coming out of the Ukraine and Russia and those sort of things. I think there was news coming out of there that probably turned that around. But the other reason why we saw stocks rebound so strongly is we have a really strong economy. I mean, our economy is doing very well right now. And if it looked like that our economy was going into a slowdown or recession or something like that, then I think we may not see a bounce like that. And so there are a lot of good fundamentals about our economy and businesses in general. And the other day, you and I and Spencer were talking about, we were texting it the night that
futures were getting crushed.
Right,
yeah.
futures were getting crushed, and Russia, Putin had declared war and invasion on Ukraine.
Yep.
And Spencer says it looks like we may be in for a long slog, and I said, well, we got a really strong economy.
Yeah, you did.
And now I didn't know we were going to bounce. I mean, the market, I had no idea.
Yeah, you did.
But that's the backdrop that we're in. We have a really strong economy. doesn't look like there's a recession on the horizon, at least in the near term. Of course, there's always a recession sometime down the road where we slow down, but it doesn't look like that right now.
And the speed at which the market moves is so fast now. I mean, during COVID, we saw that. We saw that yesterday as well. And in this sell-off, this correction, we've seen it. The speed of the market is insane with all the algorithms and everything happening. But on that Wednesday night, before when we saw futures down, we also had a conversation. And this goes to what are we doing right now, right? The market's volatile. It's corrected. What are we doing for clients right now? And we had a discussion saying, hey, let's sell these few slow growth names and buy some stocks that have just been hammered, that are trading at such good prices. And so we've done a lot of rebalancing to portfolios based on what the opportunity that we've had in this correction.
Yeah, we in fact we sold some of our you could say maybe in the category of value stocks.
Yeah.
And a lot of people would categorize them in maybe more of a value type name.
Blue chippers.
Blue chip value type name.
Yeah.
And we bought more of a growth type of investment. But that's not how we look at a company. We don't look at it, that's a value stock, that's it. They're all values. It's all, what you get when you buy a business. It's what you get in return that makes that an attractive investment or not. And so but part of that calculation is the growth of that business, the forecasted or the outlook on that business. And so when we looked at some of our companies that we like, they're good businesses, but they just weren't as good of a value proposition as another company, some other companies in our portfolio. And so we allocated a little bit more money to these ideas that we feel like will give us better return going forward than this so-called value name.
We'll see what happens.
But
we look smart right now, but the market might not be done going down.
Yeah,
we might look dumb in a week.
We're more about where are we going to look? What's it going to look like 3 years from now?
Amen. And what else have we been doing in this volatility? I've made 39 option trades this year. I probably made that all of last year, right? So the volatility provides opportunities not only for rebalancing portfolios, but also for income opportunities as well.
So do you get time and a half on your pay?
Yes.
Are you? Okay.
Yes, I do.
Okay.
Open that checkbook, Chairman.
All right.
I love it. So let's talk to the retired people that are listening, because they don't have money coming in anymore. What do retired folks need to be doing in any correction? What should they do?
Hopefully, they don't have to do anything during the correction. They've already taken care of it before, and that's why we want to make sure that before there's any sort of correction, that there's enough liquidity on the sidelines to fulfill their income needs over the next several years. You don't want to be thinking about it during the correction. You hopefully you've already planned ahead and done something about that. And that's what we try to do for our clients who are in retirement. They don't have income coming in. They don't have a lot of money on the sidelines. They need on the sidelines to put into the market. They have money on the sidelines, hopefully enough money for their income needs for the next several years. But that's what that's for. It's not to be putting back in the market. And so hopefully we've planned ahead. They've planned ahead, and they don't have to do anything. What they should do is do nothing, hopefully, and that's because they've planned ahead.
Yep, and still get their income.
Right.
Yeah, absolutely. That has to take place. You plan for the bad times during the good times, and that's what we've done for retired clients. So retired clients, you just relax. Is that fair to say?
Probably easier said than done. No, but
yeah, for sure.
Probably easier
for
said.
Sure.
Yeah.
Those that are not retired, get your cash ready. Start buying, right?
Yeah. I mean, again, we don't know where the bottom is. We just don't know. We're looking out 3 years from now, 5 years from now, and I do think there's some attractive ideas out there when you look at it from 3-5 year window. But again, we don't know. The next 6 months, what's going to happen tomorrow, we have no idea. But I feel pretty good about, there's some good opportunities out there if you're a long-term investor.
Especially the businesses that we've been buying.
Yeah, we love our portfolio of companies.
So we have no idea what's going to happen in the future. We believe this is a correction. We might, bear market.
When you say we have no idea what's going to happen in the future, we don't.
In the short term.
Well, and actually, you're right. We don't know what's going to happen in the future, but I feel there's a high probability that the investments we're making today will be good investments looking 3-5 years in the rearview mirror in 3-5 years from now.
Yes.
I feel there's a high probability, but that's not certain clarity. We think there's a high probability, and but there's never guarantees in this
it's like
business.
COVID. We started buying 10% down, and then 15, and then 20, and then 25, and then 30, and then 35, right? I mean, you just keep buying. You never know what's going to end. So you just got to keep taking advantage of the opportunities when they come.
Yeah.
And we could mistime it by 5%, 10%, and you know what?
COVID was like a really short window of an opportunity.
Yeah.
During 08 and 09, that lasted a year and a half, 2 years, and down. It just kept going down. And I remember just buying a little bit, thinking one of these days this thing's going to turn around.
One of these days. That speaks to the speed of the market now. But
yeah.
So let's talk to all those that are afraid. Let's look at history. What has history shown us when a correction takes place? Is the advice that we're telling those that are retired and those that are not retired, is it sound based on history? Okay, so the average, and this is looking back to 1980, I think there's 33 corrections here. And some are bear markets, actually. Yep, there are bear markets here. So this is bear market.
Define bear market and correction.
To me, it all feels like a bear market, especially when you're talking to a client.
Okay, what's a bear market?
Correction, down 10%. Bear market, down 20%. Okay. Some say intraday, some say closing. I don't care. You know what? It all feels terrible.
Right.
Okay. The 1 year following a correction or bear market, the S&P 500 has averaged, and this is from the lows, has averaged 24.8%. 2 years, averaged 37.4%. Of the 33, there's been 4 times in history that the S&P has been down after 2 years. So the probabilities are on our side that things are going to be looking a lot better in 2 years than they are now.
And why is that? Why is it that the market just keeps chugging ahead? It just keeps, it's a train, and it just keeps moving forward. And the statistics just show you that the reason why is, it's the anti-gravity of economic manpower and the growth of
ingenuity,
yep. and
it's just so great about this country.
The growth of our economy and capitalism. You just can't stop that train. And if you look at over the last 50 years, I have a great spreadsheet that shows the S&P 500, all the data on the S&P 500 earnings, interest rates, and it's
not just those bond guys that are smart. Brian's got his spreadsheets.
Yeah, it is a really cool spreadsheet, and but it just shows that yes, there are times where the economic engine of the United States, our economy, slows down or maybe even declines a little bit.
Yeah.
But it just builds. It just keeps building. It's like this, rubber band that gets stretched and then it just snaps back the other way. Because underlying, there's millions and millions of people here in the U.S. and globally that are working to improve their lives and improve, their businesses, and you just can't stop that engine. It's gonna rebound, and so that's why every correction that we've ever seen in the history of the U.S. Financial markets is just it's a temporary correction.
It's always temporary.
There's a guy out there by the name of Jeremy Grantham, and he's big on all the news, and he's a doom and gloom guy saying the market's going to crash. This is going to be the next biggest crash. I've had a couple clients forward that to me, and We don't know if there's going to be a crash or anything.
Is that dude selling something?
I don't know.
Selling a product?
I don't actually. I don't know.
Yeah, probably.
I don't know what he is, but I've listened to his stuff, and I would. It just doesn't affect me. I think you got to remember that we have this incredible economy. These businesses are growing year by year, and any little downturn is going to be a temporary one.
Yep.
Now maybe I sound naive and too optimistic, but that's absolutely what I believe.
And we'll round out with this thought. Okay, I've heard the 4 things that we talked about: war, inflation, debt. We're in a bubble. I've heard people in financial media say that's never happened before. This time is different. And I go back to Sir John Templeton's quote. The 4 most dangerous words of investing are "this time is different." Mm-hmm. We're going to play the probabilities, and we're pretty confident in them. So
I think we've been through something similar. Not you and I weren't alive, but after World War II or during World War. Not saying this is World War II, but we had huge high levels of debt, inflation. War.
Yep.
Post-war.
There's been some ugly times in the past, and we've always gotten through, and that's the train you're talking about. Yeah. So jump on. Choo-choo. All right, my friends. I hope you learned something today. The biggest thought I have is just relax. Yeah. Stay the course. We'll take care of things for you. Okay. With that, until next time. Bye now.
This is a